JohnATracy, How to Read a Financial Report, Wringing Vital Signs Out of the Numbers. Embark on a journey to uncover the secrets of financial reports and make well-informed business decisions with the book, How to Read a Financial Report, Wringing Vital Signs Out of the Numbers by JohnATracy. This summary aims to simplify the complex world of financial reporting by delving into the three core financial statements: the balance sheet, income statement, and cash flow statement, as well as the importance of understanding their interconnections. Learn how to decode these reports and use them to evaluate a business's financial health, compare companies within an industry, and make sensible investment decisions while avoiding common pitfalls.
Decoding financial reports. Understanding the financial health of a business is essential for effective management. In this book summary, the author emphasizes the importance of well-prepared financial reports in providing an accurate picture of a company's position. The three primary financial statements, income statement, balance sheet, and cash flow statement, are discussed in detail. The income statement reveals a company's profitability by subtracting expenses from total revenue, while the balance sheet lists assets and liabilities to provide a snapshot of a company's financial position. The cash flow statement shows how cash is being used and earned. To fully comprehend financial reports, it is crucial to understand how accountants prepare them. By comparing the financial reports of several companies in an industry, managers can gain a better understanding of their competitors' conditions and ranking. By decoding financial reports, managers can make informed decisions that will ultimately benefit their businesses. Understanding financial reports. Learning to read and connect the numbers in financial reports is crucial for inventory management and making sound business decisions. Financial reports such as income statements and balance sheets hold crucial information about a company's financial health and performance. For instance, the income statement reveals a company's profit performance, while the balance sheet displays its financial standing. By tracing the processes described by the numbers on one report, it becomes easier to understand how they drive the numbers in another report. For example, the sales revenue on the income statement is directly linked to accounts receivable on the balance sheet, and selling on credit increases the accounts receivable. To avoid a collection problem, it is essential to keep track of the average collection period. On the other hand, rising inventory without a corresponding growth in sales could indicate a problem in inventory management, leading to the need to cut purchasing. Holding inventory can tie up cash that could be invested elsewhere or accrue interest charges if borrowed. Thus, figuring out the optimal period for inventory holding is crucial to reduce the cost of maintaining inventory while maintaining sales. A company has to strive to keep the lowest level of inventory possible to improve profitability without compromising on quality or delivery commitments. Understanding accrual accounting. Accrual accounting aims to match revenue with expenses, and it involves recording and paying for expenses that span multiple accounting periods. When expenses are not paid immediately, they become part of accounts payable, accompanied by holding accounts for prepaid expenses. Companies accrue certain liabilities in expense payable accounts and track interest expenses. Depreciation and amortization are used to show the costs of assets that have an extended useful life, like buildings and cars. A depreciation schedule should be maintained for each relevant asset. Additionally, businesses must manage taxes, which can be reduced and postponed with planning. Overall, adopting accrual accounting helps ensure that revenue and expenses are aligned with their respective time periods, which is crucial for informed business decision-making. Mastering net income. Understand how net income impacts business success in the long run through this engaging insight into how retained earnings, dividends payment, and earnings per share are calculated. Learn more about net income and how it impacts your business's bottom line. Net income is your profit after expenses and should be added to the owner's equity. Retained earnings on the balance sheet are helpful for going concerns, and paying dividends reduces them. To calculate earnings per share, EPS, determine net income and divide it by the number of issued shares. For instance, a business with a net income of $5 million and 1 million outstanding shares will have an EPS of $5. If the company closes, it will sell its assets, pay its debts and distribute any surplus to shareholders. Understanding cash flow versus profit. Learn the differences to maximize revenue. Many business owners mistakenly assume that cash flow and profits are interchangeable concepts. Contrary to common belief, a healthy cash flow does not always translate into profitability. Presenting the case of selling dollar bills for 90 cents each, the book explains how a positive cash flow alone does not necessarily indicate a sustainable business model. While cash flow refers to the inflow and outflow of money, profit is generated after deducting all expenses from the revenue earned. Therefore, to ensure long-term financial success, businesses must aim to maximize their profits and convert them into cash as soon as possible. Earnings from investments and interest are considered accountable cash flows but do not add to the company's profit. Moreover, even an unprofitable business could show positive cash flow during a shrinking phase, while a thriving business might initially have negative cash flow. Thus, understanding the differences between cash flow and profit is crucial to optimizing business revenue. Rather than getting impressed by high cash flows, business managers must focus on making profits and converting them promptly to achieve maximum value. The overlooked importance of footnotes. Footnotes contain crucial data that can affect one's interpretation of financial statements, but they are often poorly written and hard to understand. While securities analysts must be concerned about them, ordinary investors can ride the coattails of the pros and don't need to unravel management misdeeds. It's important to read footnotes and understand them, but not necessary to pore over them repeatedly. Understanding financial reports. Financial reports prepared by certified public accountants, CPAs, follow generally accepted accounting principles, GAAP, and Financial Accounting Standards Board, FASB, rules and are tested by independent auditors for accuracy. Profit is a vital source of cash inflow, and auditing helps identify mistakes and deliberate fraud. The Sarbanes-Oxley Act was passed to prevent such fraud, but dishonest people still find ways to deceive. Most businesses follow income tax methods, and CPAs may choose different accounting methods while presenting a clear picture of a firm's activities. Firms cannot change methods seeking better results, but they can compensate for over- or underreported matters in later periods. Investors must follow a firm's reports over time to detect any discrepancies. Inventory management and accounting for business growth. Effective inventory management and accounting practices are critical for business success. The choice of inventory accounting method impacts profitability, taxes, and reported margins. LIFO is a commonly used method but can lead to short-term gains. Understanding the impact of different inventory methods on pricing and profits is essential. Moreover, cash inflows and outflows are essential considerations in financial management, and a focus on accurate accounting for costs and assets depreciation is critical. Inventory management and accounting are critical components of business success. The choice of inventory accounting method can significantly impact profitability, taxes, and reported margins. Most companies use the LIFO method, which lowers margins but leads to some short-lived gains. However, it is crucial to assess which inventory method works best for a company's pricing and profit strategy. Additionally, financial management requires a focus on accurate accounting for cash inflows and outflows. Depreciation of long-term assets is standard practice, but understanding accounting theories adds significant value to long-term decision-making. Furthermore, costs associated with assets should not be immediately expensed but appropriately depreciated in line with revenues. Therefore, businesses need to consider effective inventory management and accounting practices to optimize growth and financial stability. Making numbers work for investors. Investors and lenders rely on financial reports to gauge a company's performance. Report numbers like debt versus equity and return on sales, and ratios such as P/E, are crucial to understanding the business's short-term solvency and profitability. However, many investors are ignorant of the limitations of financial statements. Management accounting and financial reports. Management accounting aims to help internal decision-makers make informed choices that drive the company's success. Unlike financial and tax accounting, management accounting is not regulated, which allows for the development of personalized standards and delivery methods. By focusing on strengthening the company's profit position, managers are better equipped to understand their contributions to overall profit and tie those lessons to their goals and department. While financial reports are useful starting points for investment and lending decisions, they should not be taken at face value. Track key numbers over a few years, and seek additional information to deepen your understanding of the company.
In conclusion, mastering the art of reading financial reports is essential to making sound business and investment decisions. JohnATracy's book unravels the complexities of financial statements and their interconnectedness, providing valuable insight into evaluating a company's financial health. Remember that the balance sheet focuses on assets, liabilities, and owner's equity, while the income statement reveals a company's profitability, and the cash flow statement uncovers how much cash a business generates or consumes. Furthermore, stay vigilant while reading financial reports and diligently scrutinize footnotes and other relevant information to make well-informed choices. Now, it's time to apply these lessons and take control of your financial destiny.